After years of markets rewarding capital light businesses, there's been a shift towards companies controlling scarce, tangible assets. Old economy businesses are seemingly becoming the gatekeepers to technology's growth, and we're seeing this with pricing power reemerging across areas like energy or infrastructure. Can you share what you think the driving force of this shift is?
Hi, Christina. Yes, we are witnessing a shift in market leadership from an environment that historically rewarded asset light businesses to one recognizing the strategic value of scarce tangible assets. Several structural forces are driving this shift. One, geopolitics and the need for strategic autonomy. Two, the AI infrastructure build out. And three, the capital cycle and years of underinvestment. On the geopolitical front, while the outcome of the conflict in the Middle East remains uncertain, some of the longer term implications are becoming clearer. The world is moving away from globalization. Historical alliances are being reassessed, and many countries that have experienced shortages in oil, in LNG, helium, fertilizers, are now focusing on strategic autonomy. Supply chain resilience is becoming a national priority. Access to energy, critical minerals, semiconductors, industrial capacity has become strategically important and therefore more valuable. The second major driver is the massive AI capex cycle. Hyperscalers are expected to spend hundreds of billions of dollars on AI related infrastructure. Power demand, after being flat for a decade, is meant to increase by 20% over the next 5 years. This spending is running into physical constraints. The bottlenecks are electricity, grid interconnection, cooling, land, transformers, gas turbines, copper. This is shifting pricing power toward the companies and the countries that control scarce physical capacity.
What about the supply side?
The capital cycle is playing an important role. Decades of underinvestment have left many old economy industries with limited spare capacity. If I look at global oil and gas capital expenditure today, they are still 30% below the peak from 10 years ago. In many natural resources industries, bringing new capacity online can take many years. In mining, for example, the timeline from discovery to production can often stretch well over a decade. So the result is a structural step up in demand at a time when supply is likely to remain constrained for several years. So this is resetting the commodity price deck structurally higher. So we're moving from a world in which value accrued primarily to capital light platform that aggregated and controlled demand to a world in which controlling the supply of scarce real asset is a major source of value.
Given all of this, can you share what the global value team's latest positioning is?
Our exposure to real asset is over 30% of our portfolios. It has steadily increased over the past decade as the US market favored asset-light businesses. It forgot about these sectors where competitive advantages are rooted in physical property, not intellectual property. Those are long duration assets with low obsolescence risk, and our exposure takes many forms: mining, fertilizers, timber. On the energy side, we own integrated companies, oil sands, deep water, oil services. In real estate, we have exposure to Hong Kong, US, and London offices or US residential assets. We also own physical networks. It can be midstream, pipeline. It can be infrastructure asset like hospitals or cable networks.
Thanks, Julien. It was great hearing from you.
Thank you, Christina.